Good evening. Happy Sunday evening. I hope you had a wonderful weekend. You're ready to get back into your week. The last week of October. Then we reach November and then we get into December and the year is over. 2024, the year of the elections. So a lot of uncertainty, a lot of things are there up in the air. And I hope by next year, this time, we have a lot more clarity in the world. A lot of the global conflicts I wish and I hope and I pray have concluded. And we've kind of reached some kind of a settlement in these, and the world is a much more peaceful place. I'm always hopeful, though I sound pessimistic at times. Me and Sashwath are very hopeful. We also do live in this world, and nobody would want any conflict, and we would all love some peace. That being said, this is a third part to a following series which I've been talking to Sashwath with, starting with the podcast on Saturday evening video, which I spoke to him about the credit. Then the Sunday morning podcast where we spoke about unicorns and camels. Comes to the same kind of concept comes into investing now. Because of the free money world we lived in now to the not so free world of money we live in, the way we have to approach and think about investing also has to change. There's a very famous guy in the US. His name is Kevin O'Leary. He's a financial influencer and an investor and a very rich man who's made his money in Shark Tank and all kinds of investment. And he's now worth over $400 million. And he recently came out talking about modern portfolio theory. And he says all of us should use modern portfolio theory to become rich. What is modern portfolio theory? It was developed by Harry Markowitz in 1952. What he basically, as an economist, he advocates is diversifying your investments to reduce the risk by spreading your money across various assets. So what does O'Reilly suggest? He suggests that investors should follow the principles of MTP and 99% of the sovereign wealth funds across the world and create a diversified portfolio to maximize returns within a risk tolerance. So he says, advises not putting more than 20% in any one sector and never leave more than 5% in any single stock or bond. Going on, harping on the fact of being diversified. What does Warren Buffett and Charlie Munger say to all this? Well, Warren Buffett and Charlie Munger feel exactly 180 degrees opposite to what they're saying. They say this kind of MPT is all this misguided focus on numbers more than stressing on the importance of understanding the core concept of the business and investing as a business owner. Again, it gets into something like what trading is. You're basically betting. Across the table, it's like having a roulette table. And you have black, and you have red, and you have numbers, and you have the wheel. So what Larry is saying is, you take your chips, instead of putting 100 chips in one spot, or putting 50 in two spots, he says you put 1, 1, 1, 1, 1, 1 everywhere. And by spreading your bets, you'll win. Somewhere you will win. Though you may lose somewhere, you'll win somewhere, and wherever you win, that volume will be so great that you will make up the loss, where you suffer the loss everywhere. That's what basically he's saying. At least that's what I've understood as a layman. This is why I brought Sashwath into this, because I'm a layman and know this. Sashwath actually studies the subject, so he knows this far more in nuance than I do. And that's what Buffett says. He says you can possibly do more harm than injury. Because if you don't invest in good businesses, you're not really investing. What you're doing is basically gambling. So he have this thing that sovereign wealth funds manage like this. And I agree with what Warren and Charlie say. If you have $100 billion in your disposal, I'm the Saudi wealth fund manager. I have so much money, I can do anything I want. I can buy the roulette table myself and I can do what I want with the table. I mean, that's the kind of money they have. I am not. I'm a very small investor with very small funds. I can't even afford the money to go stand on that roulette table. So it sounds great, all this MTP and it's all very theoretical. On a practical level, I'll have to take what Buffett says and take Buffett's approach. And considering the current market where interest rates are going up and getting funding is tough and finances are tough and your job security is uncertain, like what Sashwath said in the first part of the series, that he was talking about credit. And he's saying you should be prepared for this and open your Excel sheet. I hope some of you have already started doing that since that video Sashwath spoke about it. Taking all that into consideration, I feel people should be more cautious in putting their bets, as Larry says, on the table. Larry says on the table. And I rather be more like what Buffett and Charlie says. Study, do research, and be a business owner. And not worry about diversifying so much. Yes, if you have lots and lots of money, you can think of diversifying. If you have very small capitals, like most of my viewers, you do, and I do, I don't think you can be affording to do all this. So I thought Sashwath can first talk about this theory in economics, why it came about, and who this Harry Markowitz is, and what he thinks about this, and then say furthermore to what Warren and Charlie said, and also say what he thinks about the current environment in a more detailed manner than I did. Sashwath.
So, modern portfolio theory is just a jargony term for saying that you want to invest in places which aren't correlated with each other. So, what does that mean? You want to invest in places, suppose in one avenue it's going to move in a different direction than the other avenue, or how one avenue moves has no bearing on how the other avenue moves. This is theoretically good for you because this means that when your stocks, suppose, do very well, then you're doing great. But in the case that your stocks perform badly because the economy is performing badly, then you want to sort of pad out your portfolio with a little bit of bonds so that the bonds move in a different direction from your stocks and you have this balancing out effect in your portfolio. That is what modern portfolio theory talks about. And modern portfolio theory is basically saying measure the volatility in your portfolio and measure the correlation between your different assets in your portfolio and fine tune it according to the level of risk is defined by your volatility in the portfolio. So you adjust your risk tolerance according to that. I think it's a bunch of bogus because yes, if you consider volatility to be risk, then definitely don't invest in stocks because stocks are basically full of volatility. It's filled with volatility. But if you've seen our previous videos, in the long run, stocks tend to always do better than bonds. And if there is a place to be in the long run, it's definitely to be with stocks. Stocks are your best friend. And coming to bonds, when the stock market is overvalued, you can sort of diversify into bonds, but not because you want to diversify for the inherent purpose of diversifying, but you are switching over to bonds because you think there's better value to be had there. Investing can be boiled down to this much. Can you buy a 10 rupee note for 5 rupees? This is your main question. Where can I invest so that I can buy a 10 rupee note for 5 rupees? Who's willing to sell me a 10 rupee note for 5 rupees? Surprisingly, this might sound stupid to you. You might be like, you know what are you spouting on about? Who's going to sell you 10 rupees for 5 rupees? I think Sashwath finally lost it. But that's not the case. Mr. Market, as in the Benjamin Graham in The Intelligent Investor puts it, Mr. Market sells you 10 rupees and not just 10 rupees, he sells you 20 rupees notes for 5 rupees. And this is the kind of irrationality you'll see in the market. You'll see companies like ITC trading for 270 rupees, or I think at one point it was trading at 170, 130 and stuff like that during 2020, 2021. And that was a great time to buy. And you look at companies, exceptional companies which have absolutely no flaws with them, just being out of favor because Mr. Market thinks that this is not the place to be right now. And you should be able to swoop in then. You shouldn't, this is like, so now imagine this. There are 10 sellers in the room. Some of them are selling a 20 rupee note for 50 rupees. Some of them are selling the 20 rupee note for 5 rupees and 10 rupees. Would you say, I want to diversify and buy the 20 rupee note for 50 rupees as well as 5 rupees, or would you just buy the 20 rupee note for 5 rupees and 20 rupee note for 10 rupees? That's the fundamental question I want to put to you here. Because if you believe that you'll only buy a 20 rupee note for much lesser than what it's valued, then diversification for the sake of diversification does not make sense for you. Because you as an investor should be into investing for the long term. So it shouldn't matter to you if, say, the value of your 20 rupee note has now come down to 10 rupees, but eventually you know that stocks do perform and you've made the right decision and you are going to see your value actualized. This is what Warren Buffett and Charlie Munger argue. They say that don't waste your time allocating capital because you want to lick your wounds when it looks difficult for you. Don't do that. If your wounds are too much to handle, then don't look at your wounds. Just look at it every once in a year or every 2 years even, sometimes Warren Buffett says. This is the kind of investing you should be doing. And I also strictly believe that you shouldn't diversify for the sake of diversification unless you have some other ulterior purpose, such as you need the money or you'll be getting the money out in another few months or something. Then that's a different story altogether. You should be investing according to your time frame. But that still doesn't mean that you invest in a bad asset just because you want to diversify. Diversification shouldn't be sort of proponent for you to sort of reason out investing in terrible places. You should be investing in great places. And if it means you're not as diversified theoretically, then great, it's okay. Or if investing in good places naturally leaves you diversified, even better. But that being said, diversification shouldn't be your main factor while investing in the long term. It should be sort of a side note to your main investing of value investing. That should be where you stand, is what my opinion is.
I agree. And like my father used to say, for a gambler, every single thing looks like something you can make a bet on. So if you're a person who likes gambling, then you can look at any situation and look at it and look at the odds on either side and look upon it like placing a bet. At a time when everything was free, especially cash was free and freely available, if you were lucky, you could do this. You can keep making bets, and we've seen this happen throughout, and we're going to see this in the coming real estate crisis in the US in the commercial sector, like what Sashwath had spoken in a video a couple of weeks ago, when Charlie Munger also, he was talking about what Charlie said about the loans which are going to turn bad there because of people taking gambles because of free cash. It kind of ties into all that. If you have free cash, you can do whatever you want, and especially if it's not your money, definitely you can do whatever you want. But when you don't have free cash and you're paying very high interest on these kinds of loans and you are burdened already, you should be very cautious and slow down. Again, like Sashwath said in the end of the last video, we are in a desert. In a desert, you don't want a unicorn. You want a camel.
Yeah.
So, again, be prudent, be cautious, be wise.
Mainly, what you guys will see in terms of diversification is a wealth manager or a investment advisor will keep pushing assets which inherently, after looking at our videos and after reading Intelligent Investor, you'll be able to say, hey, you know what, this doesn't make sense. Why is this guy pushing this onto me? Why is he asking me to buy this? He's just saying diversification, but this doesn't make sense to me. Great. That's a great insight to hold on to. It's a great gut feeling to hold on to. Think twice about everything your investment advisor tells you, and definitely get a SEBI registered investment advisor. We are not SEBI registered investment advisors.
Correct. And like Anand said in the other video, 21,000 crores has flowed into the Indian stock market in just 2 months. And most of it by new small investors who are having severe FOMO of missing out. And majority of that money has landed in small cap companies, and that's being decimated. There's been huge losses. People have lost a lot of money. The shirts on their back. So please be careful out there as you try and venture into this murky water and tough times. Thank you for watching the video. I hope you enjoyed it and found it informative as always. We are not trying to be negative here. We just want to have a balanced approach to everything. That is why I've been handling the same concept in 3 videos. That how it is, what the rules of the game should be correlated to the environment. If the environment has changed, your rules of the games must change. So now we are living in a desert, so we must also apply the rules of desert life, and not assume that we're living in an abundant rainforest where water is freely available. Chalo. Thank you for watching the video. Do subscribe and turn on the bell notification, and I'll see you in the next one soon. And the next one with Sashwath will be something is very close to him, something he's always talked to me about, and we've chatted many long conversations about. I thought I'd ask him to share it with you guys before he heads back to college. Thank you.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.